Hello and welcome back to Property Price Guru, where we speak with property professionals about the industry to help you on your property journey. Today, I'm delighted to be welcomed by Jonathan from the Ramp Group. Jonathan's a mortgage broker. Hello, Jonathan. How you doing?
Hi Jacob, how you doing? You okay?
Really well, really well. Yeah, I imagine you've. We briefly just spoke about it before we've come on. You've had a hectic few weeks with everything going on. It's been,
Yeah,
I imagine challenging to put it politely.
yeah. The market's been up in the air, and I think a few files have been up in the air between brokers as well recently. So yeah, it's starting to calm down a bit now, which is good. I think the lenders have started to calm down, which I'm sure we can talk about later. But yeah, looking good at the moment. Positive market, very busy.
Before we get into that, perhaps you could just give us a bit of a breakdown on obviously what you've done in the past, Jonathan, and your journey
Yeah,
to where you are now.
no problem. So I've been in mortgages now for 20 years. Started off at a secured loan brokerage in Watford called loans.co.uk. That was acquired by Bank of America, and it subsequently closed in 2009 in the credit crunch. So I moved over to Connell's Group as a broker. Was there for a couple of years, did all right, and they promoted me to an area mortgage services manager for Sequence, which looks after kind of loads of different brands of Connell's Group. So I looked after that across the home counties, kind of Hertfordshire, Buckinghamshire, Berkshire, that kind of area, and stayed in that role for 11 years. So I was there 13 years in total at Connell's Group, and the time came for me to I think the phrase is create your own destiny, or someone creates it for you. So I thought it was time
I like
to
that.
do that,
That's a good one.
and yeah, I think it was the old CEO that taught me that. So off I went and started creating my own thing.
And you're enjoying it so far?
Yeah, loving it. There's a lot to learn. There's a lot that nobody explains to you, and you kind of got to find your own answers, which is fine. I quite like all that, and a lot of that is part of the process, I guess, of doing your own thing and building your own dream or vision or whatever you want to call it. So that for me has been really interesting, actually. Lack of money for a good few months is quite as fun while you're waiting to get signed off by the FCA and all those kind of things. But we're up and running now, and we're off, and things are looking busy, which is good. So.
And straight into the deep end with the events of the last 2 weeks.
Yeah, great time to choose to be a broker. I mean, I started being a broker in 2009, so but I'm used to a challenging market. So for me, it's actually quite a good thing because it separates the wheat from the chaff, and the better brokers stay around and stand out to a lot of customers on referrals and things like that because you do a good job, and because you're tenacious and you don't let things go. So
Just how comparable is it? You mentioned 2009 there. Just how comparable is it as a broker now compared to those times back then?
It's very different. I think the grip that the government and the regulators have got on the industry since 2009 and the lessons they've learned have massively helped. I think the pardon me, the affordability calculations, things like that, the criteria that's set out, the liquidity requirements the lenders have got to have, all that kind of stuff has meant we're on a much more solid footing than we were in 2009 when the kind of the rug was literally swept away from the whole industry, wasn't it? But at the moment, yeah, we seem to be far better positioned as a country and an economy to kind of bounce back and actually take advantage of it if you can do.
Yeah, it's interesting when you look at it at the moment, because obviously the last 2-3 weeks have probably been unorthodox in terms of it's been a whirlwind, probably, isn't it, in that
Yeah.
period. I mean, have you seen, is that caused drastic changes at your end, or is it more a case of you just got to ride through that storm and hopefully get the other side of it sooner rather than later?
It's a good question, and I'm sure my bank manager won't thank me for saying this, but a lot of customers I've said, actually, don't do anything. You're on a good deal. Just wait and see what happens. We can look at reserving a product if you want to have one there in the bank, and we're waiting for that to go through. But fundamentally, some people just need to not panic and as you say, ride out the storm. There's a age-old process I learned at Bank of America that I used to harp on about in my previous job as a sales manager, called the Sarah process. And it's where you go through a big change, either in a business or an economy or anything like that, a big organizational or structural change. The Sarah process is the natural feelings that we feel as humans as we go through a process like that. So if you look at the word Sarah, S-A-R-A-H, the S would stand for shock, and then you go through to anger, which is A, R is rejection, A is acceptance, and then H is hope. And it kind of is very natural for everybody to feel those things. So when you see an interest rate just spike overnight, the shock and awe of that, and the media getting hold of that and running with it and all the rest of it is quite a spellbinding thing for people at times. So that then quickly turns to anger, and people think, how could you do that to me? And, you know, this is outrageous. We need to sack the chancellor, or we need to, you know, I hate the world. And then you get to rejection, and people say, well, no, I'm not having that. I'm just not doing anything, or I'm going to throw away my current fixed rate. I'm going to go and find a new mortgage, or, you know, whatever you do to throw away an idea or a thought in your head. And eventually people start to come around to acceptance. So I say, okay, well, this is the situation that we're in. This is the market that we're in. How can we turn this into something that works for us? And eventually hope, whereby people are thinking, okay, well, I can still move. There's still money at the banks to lend. There's still good interest rates, albeit not 1% interest rates, but, you know, 3 or 4%. If I could have offered you that in 2009, I'd have bitten your arm off. So, you know, there's still a fantastic marketplace out there. And I think the opportunities that are out there in that market are still huge. So that's kind of how we walk people through it.
It's a great analogy. I like it. I guess the question would be, where is the nation right now generally for people whose fixed rate? I'm guessing somewhere between anger and rejection, maybe somewhere around that sort of. There's possibly still a way to go to acceptance for a lot of people, I'm assuming.
Yeah, I mean, I don't want to talk too much about politics, so I won't go too deep into that, but I'd imagine Kwasi Kwarteng's probably feeling a bit of that rejection right now from the country. So I think we are struggling sometimes to get to acceptance, and there's been a lot of, I wouldn't call it false inflation of the market, because actually it's been really useful for people like first-time buyers and things like that to get onto the ladder, where we have inflated prices in some areas and a growing market. It becomes harder and harder for those first-time buyers to buy. So things like Help to Buy, shared ownership, all of the housing schemes that are out there, I think they help support the housing market. And I think if we didn't have any of those in place, then we would have seen probably more of an adjustment than we've seen, which, you know, we can be grateful for, but we also have to have an air of caution too, because when those things do expire, if we run out of money to support those kind of incentives, then it can start to cause problems. So that is something that I think is possibly going to be more prevalent as the time goes on.
How much of this do you think comes down to perception? Because I think I'm right in saying you would know a lot more about this than me, but I think I'm right in saying that the historical average for interest rates hovers around the 5% mark, and obviously we've been used to, you know, the lows of recent years and you know, fantastic mortgage rates from a homeowner's perspective. Obviously now I think I read earlier this week that the average 2-year fixed is hovering around 6% now, which feels like a drastic jump if you have the perception of, well, look where it was to where it is now. But actually, if you have the perception of, well, historically it's ballpark around average, how much of it actually comes down to that?
I think you're absolutely right. Historically, that has been the kind of average and ballpark figure that you would look at. We've been really fortunate, well, I say fortunate, but we have been fortunate that the base rate has dropped so far down that we've all managed to take advantage of those low interest rates, and the price war, I guess would be a way of putting it, between the different lenders, where they've competed. The FCA actually brought in a rule quite a while ago. I think it was under MMR, which was the new mortgage market regulations in 2014, I think, from memory, where they stated that we had to offer the cheapest possible deal for the client. So brokers were making recommendations for, well, this lender will do you a quick mortgage offer, or this lender will be really good for a new build, or whatever reason they wanted to give as to why they were recommending. And now we have to give a reason as to why we haven't recommended the very cheapest deal available for that client, if that isn't the one that we've recommended. And therefore, when you had lenders coming to brokers and saying, you know, we want more of your business and how can we get more of that, the almost every broker in the land would have to reply with, well, I just have to go with the cheapest deal. So you need to make yourselves more available in terms of cost. And therefore, there was almost a race to the bottom in terms of who can offer the most competitive deal, which is good because it made borrowing cheaper and it's benefited a lot of people over the years by doing so. I think the danger of that is that we're now seeing the flip side of it. And when that starts to creep back up, there are people who haven't lived in a housing market that has been more than 0.5% as a base rate, you know, and that's quite scary because it has been, you know, late 80s, for example, 15-16% interest rates were not unheard of. I wasn't there, although I lived through that, but I wasn't a broker at that time. Thankfully, I'm not that old. But since the kind of mid 2005, 2006, I think the interest rates were about 7%, something like that. And then it kind of dropped overnight in 2008. So yeah, I've had experience of seeing rates at about where they are at the moment, and some people probably haven't, and it's probably something of a shock to a few people. My viewpoint on it has always been, irrespective of what your interest rate is today, whatever it will be, as we know, I don't want to say we haven't got a crystal ball because I hate that cliche, but we haven't. We can't tell the future, but if your interest rate goes up 2, 3, 4%, this is what your payments would be. If you can't afford that now, don't do it, because it could well end up being like that in the future. And that's quite a sobering thought for some people, but also the right thing to do, which helps us sleep at night and make sure that people get the right outcome.
I think you're right. I think taking that long-term view is probably quite important, isn't it? I mean, what advice would you give? You know, obviously you're referring there in terms of people jumping into the market right now and getting a new product. I think, again, correct me if I'm wrong, but I think I read that there's approximately 2 million people in the UK next year in 2023 whose fixed rate deal is going to come to an end.
Yeah.
And funny enough, I'm one of them. So be listening to your answer on this one.
Yeah.
But you know, in that particular situation, obviously the rate and the monthly payments is going to be a lot more than it was beforehand. I appreciate it's difficult for you to answer, but is it a case of, do you look at that and think, well, do you know what? I'll lock into a 2-year fixed rate deal. Obviously, it's going to be a lot more than what I've been used to paying, but I'll lock into a 2-year fixed deal and hope that the rates come back a little bit. Or do you think, no, the rates are here to stay, let's just lock in for 5 years and get on with it?
It's a good question. The slight frustration that I'm going to give you as an answer is it depends on every single person's situation. So it's almost the impossible question to answer, because what may be right for somebody to look at for a 2-year product might be totally wrong for somebody who needs a 5-year product. I think the only answer I can give to that is speak to an advisor that assesses everything about your needs. So not just what's going on now in your life and what's already happened in terms of your pay, but what are your future plans? You know, you might want a 5-year fixed rate, but you might also move in and have the neighbours from hell and you can't wait to leave. And then you're locked in for 5 years. So what do you do? As long as you're armed with the information, you know how much it's going to cost you to get out of that mortgage, or it's even a portable mortgage, which means you can take the mortgage with you to another property. Sometimes that can alleviate that stressor for people. But there might be things like future needs. If you're thinking of starting a family, for example, and therefore you want to look at upsizing in the future and things like that, there may be timeframes for that. If you want to relocate for jobs, you know, there's loads of different circumstances
rather than just the rate, I guess.
Absolutely. The good thing with an advisor or a broker is that what we can do though is look at that information, almost assess what those needs are, but also give you some pointers as to how you can alleviate some of those questions. So if you've got, let's say, a future need and you want to move, and we can look at a portable mortgage. If you want to pay it off quicker, then you can look at lenders with overpayments. There's loads of different ways in which you can build and shape your mortgage to how you see fit. So yeah, in answer to your question, I have not answered your question, Jacob. So I hope that's right.
I get it. To be fair, I probably walked you into a dead end with that question, because I appreciate it's a very difficult one for you to answer, and probably everyone, I imagine, or certainly a lot of people who are in that similar situation where they've got a fixed rate deal coming up that's expiring next year, a lot of them are going to be asking the same question. And it probably goes back to what we touched upon earlier with, well, actually perception, because whilst it's not particularly enjoyable going from a mortgage rate that might be around 2% to something like 6%, that's obviously a bit, but actually when you compare that to a historical average, it's probably not, it's not disastrous. It's that initial shock, isn't it, getting over that. And going back to your Sarah analogy earlier, that's probably getting to the acceptance part of that, isn't it? And just trying to.
Well, that's exactly it. I think I spoke to a client. I won't name names, obviously, for GDPR and all the rest of it. But we spoke on the phone a couple of nights ago, and his interest rate had gone from 3 point something to 5.69 almost overnight. And he was going through the whole kind of shock, anger. I can't believe the lender's done this to me. Surely they must have better rates for existing customers, all that kind of stuff. When we sat down and worked it out, the guy's mortgage payment had gone up by something like £47 a month. Now, nobody likes their payments to go up. I get that, especially in a cost of living crisis and all the rest of the things that are going on in the world. But in the grand scheme of things, he was like, what's my mortgage gone up 50 quid a month? I was like, yeah. He was like, oh, I can swallow that. Let's lock it in now. And there's the reality check sometimes that we get. So the other point I was just going to say is that some customers can also renew their fixed rate or select a new product, for example, 6 months before their current fixed rate expires. Okay. So, if we're in October now, if your fixed rate is up in March or April of next year, speak to your broker now, and therefore they can have a look at what's out there and potentially even reserve you a product now that doesn't complete until your fixed rate expires, so that you don't get charged an early repayment fee. All of that said, those rates that we secure now may not be around in 6 months' time, so therefore it's worth having a look about what's there now, working out your budget, seeing whether it's affordable for you to do that, and kind of getting that advice from them now.
But in that particular situation, by securing them now, let's say if you're able to secure a rate 6 months before your product actually comes to an end, you reserve that rate. Is it possible for lenders, let's say if interest rates really kick on, in that period after you've reserved the rate, is it possible for lenders to pull that? Or once that's secured, is that it? It's locked down?
That's the thing. Once you've secured your rate's secured. So as long as you've got your mortgage offer and you're ready to go, then there is no reason why. You have to check because it depends on the lender, and it also depends on how long that lender will honour an interest rate for. So let's say some lenders will give you a 6-month mortgage offer, for example. So therefore you can get that mortgage offer 6 months before your mortgage is due to expire, and therefore that rate will continue until you switch it over. Some will only offer you a 3-month mortgage offer. So therefore you could reserve it for 3 months, but then in 3 months' time, if you've still got another 3 months before your fixed rate expires, you've got to then review the market and see what's out there then. But even that might be cheaper than what's going to be there 6 months down the line, Yeah. So, and if it isn't, hopefully you haven't lost anything other than a bit of your time. There can be fees. So again, speak to your broker about those and your advisor and work out, is this going to be cost effective? Am I prepared to pay, I don't know, 99 quid or whatever the lender charges me to reserve that product in order to be at the front of the queue if I need to be?
Well, one question I did have, Jonathan, is looking from, obviously I'm involved in the property industry. I'm not a broker myself, but even for someone like myself that's involved in the industry, I still see, probably is what 99.9% of the public see, obviously what's going on through the eyes of the media, which has been quite gloomy, shall we say, in the last few weeks. But based on what the media has reported, how near to that situation actually is it from your perspective on the front line? Is that an accurate portrayal of what's going on, or is it a case of, well, look, it's not great, but it's really not as bad as, there's a lot of perhaps gloomy headlines to sell newspapers going on as opposed to what the reality is?
Yeah, no, I've got to be careful what I say in terms of, I don't want to get taken to court for libel claims or something, but I think a lot of it has just been farcical in terms of how it's been reported, to be honest with you. We had a headline come out that said something like 9,000 mortgage products had been taken off the UK mortgage market overnight. And that's true, they did, but that's because the analysts, I guess, at the lenders couldn't work out which way it was going. So they all just said, look, remove our product range, we'll have a look at the market, and then we'll bring our products back out. Some have taken a while to come back, some came back the next day.
Right, okay.
So, you know, I don't want to quote numbers and get this wrong, but I reckon out of the 9,000 that were taken away, it's probably 8,000 that are back on the market. So it's
I guess when you break it down and explain it in a logical way, like you just have, it really doesn't sound so bad, does it? But I guess the way you just explained it probably won't sell too many newspapers. But
yeah, well, this is it. But I think the analogy would be if you were Tesco, for example, and somebody came out with the inflation costs and said, right, overnight, the cost of, I don't know, bananas is going to go through the roof. We don't know what it's going to be yet, so don't, you know, but it could go through the roof. I'd imagine Tesco's are going to say, okay, let's put all the bananas back until we know how much they're going to cost us to buy. Yeah, once we know how much they're going to cost us to buy, we then know how much they cost to sell. It's really basic as that.
Quite simple when you look at it like that, isn't it?
Yeah, there's no conspiracy from the lenders at all. Their liquidity's high. They want to lend money. They've all got targets still to hit this year. They want to move their business forward, and it's how they make money is by lending money. So, you know, it'll be fine.
Do you think I watched a clip recently of Martin Lewis, the money guy? I don't know. Obviously, he's regularly, you know, speaks about these sort of particular situations, and he came out. I watched a clip of his last week, and he referred to the mortgage market as a ticking time bomb. Was his exact phrase, which might fall into the category of what we were just speaking about. But they were the words he used. He said ticking time bomb, and he suggested that potentially by spring we could have a real problem on our hands unless there's intervention from the government and they perhaps relax sort of lending criteria and those sort of things. Do you think, from what you're seeing on the front line, is government intervention necessary to change anything and soften the blow next year, or is that perhaps a bit of an over-exaggeration?
Yeah, I don't want to sound like a lobbyist for one way or the other, to be truthfully honest with you. There are people out there in the media whose opinions could be construed as trying to lobby for change to happen. To what agenda, I'm not sure. But, you know, Martin Lewis recently said, now's the perfect time to go and speak to a broker, I believe, were his words. So, you know, is there going to be a ticking time bomb for the mortgage market? I don't know. I think that the regulations, like I say, that have been there for the last 12 years, something like that, 13 years, the work that has gone into that at the lenders to make sure that we don't fall flat on the floor like we did before, I would be confident there's a lot more liquidity out there and a lot more processes in the background. There's been a lot more compliance and making sure of the regulations and ensuring that what the lenders are doing is sensible, that I think the lenders are going to be a lot happier to lend even in a downward market than they were in the last downward market, if that makes sense. Okay. I think government intervention is always welcome. You know, I'm never going to say no to someone throwing billions of pounds at us and saying, crack on, let's lend some more money. Great. No one's going to say no to that. But like I said earlier, we've just got to take it with a pinch of salt, because it also depends on whether that inflates the market artificially, and when that adjustment comes, it could then bite a bit harder.
Yeah, that makes sense. I think like we sort of touched upon already, really. I mean, it's the same, I guess, in other aspects of this industry. Certainly from the agents I've spoken to in the past, I sort of know that they share a general frustration that actually what's reported in the media compared to what's happening on the front line is quite different. So it's great to do things like this and just try and break that down for people. So people that are at home and maybe a bit worried and thinking, you know, is now the right time for me to jump in and get a mortgage, or, you know, my fixed rate's coming to an end next year, what are my options? Just great for them to understand, you know, what the reality is, as opposed to what they're reading on the BBC website, for example. You know,
exactly that.
It's not always exactly the same as we've discovered today. One thing I will do, if you're comfortable for me to do this, Jonathan, in the description of this video, I will actually put Jonathan's email address. So if anyone's got any queries or any questions, or is considering getting a mortgage, then definitely have a chat with Jonathan, and he can certainly guide you in the right direction, whether that be a case of looking to get a new mortgage or potentially a new deal if your fixed rate is coming to an end. I think that pretty much wraps up everything we wanted to touch upon today. So really appreciate your time, Jonathan. Thanks for coming on. It'd be great to chat and find out a bit more about the mortgage market, and hopefully it'd be great to get you back on as well at a later stage, depending on what happens, just to see if there's been any changes as well.
Yeah, absolutely. And like most people in finance, I'll take back everything I said next time we meet, and it'll all be completely different. So, but thanks ever so much for having me on, Jake.
It's not so difficult to retract questions, but retracting stats is a little bit more difficult. But
yeah, absolutely.
I really appreciate your time, Jonathan. Thank you very much.
No problem. Good to speak to you. Thanks, Jacob.
Bye bye.